Exemption of income and gains derived from a participating interest. Under the UAE corporate tax regime, certain income and gains derived from a participating interest may qualify for exemption from corporate tax. This exemption applies to holdings in both resident and non-resident companies, provided specific criteria are met. The goal of these provisions is to promote investment in both domestic and foreign companies while maintaining fairness in the tax treatment of such income. A participating interest is a significant ownership interest in the shares or capital of a company that allows the shareholder to exert some level of influence or control over the activities of the company. The income and gains derived from such an interest are treated favorably under the tax regime, which incentivizes long-term investments in companies both within the UAE and internationally. The conditions for a participating interest are consistent for both resident and non-resident companies. However, there are certain clarifications and exceptions regarding the tax treatment of resident participations. For instance, a participation in a qualifying free zone person or an exempt person is treated as meeting the subject to tax requirement for the exemption, even though these companies may not be subject to corporate tax under the standard tax regime. 1. Criteria for a participating interest. As with other exemptions in the corporate tax regime, there are specific conditions that must be met for a participating interest to qualify for tax relief. A taxable person must hold a participating interest for at least 12 months or intend to hold it for a minimum of 12 months to be eligible for the exemption. When these conditions are met, the following income and gains derived from the participating interest will be exempt from corporate tax. A. Gains or losses on transfer or disposition. Any gains or losses resulting from the transfer, sale, or other disposition of the whole or part of the participating interest will be exempt from corporate tax. This applies to both resident and non-resident participations and covers the full spectrum of activities involving the transfer of ownership or interests in a company. B. Foreign exchange gains or losses. Foreign exchange gains or losses that arise in relation to the participating interest will also be exempt from corporate tax. This provision ensures that fluctuations in currency exchange rates do not result in a taxable event for the holder of a participating interest, providing tax relief for businesses with international operations. C. Impairment gains or losses. Impairment gains or losses related to the participating interest will be exempt from corporate tax. Impairment refers to the reduction in the value of the ownership interest due to various factors, such as changes in market conditions or financial difficulties experienced by the participation. This exemption ensures that businesses are not penalized for potential declines in the value of their investments. 2. Non-deductibility of expenditure related to participating interests. While income derived from a participating interest may be exempt, it is important to note that expenditures incurred in relation to the acquisition, transfer, sale, or other disposition of the participating interest are not deductible. This includes various costs associated with the transactions involving participating interests, such as professional fees, example, legal, accounting, and advisory fees, due diligence costs, litigation costs, commissions and brokerage fees, other associated costs. These costs are considered part of the investment process and are not deductible for corporate tax purposes, even though they are incurred in relation to activities that could generate exempt income or gains. 3. Income exempt from corporate tax. It is important to clarify that only the income received by the taxable person in their capacity as a shareholder, i.e., as an owner of the ownership interest, can benefit from the exemption. This means that income such as dividends or profit distributions received from the participation, as long as they meet the exemption criteria, will be tax exempt. However, Income earned from a participation that arises from other types of relationships will not qualify for the exemption. For example, income received from a debtor-creditor relationship, example, interest income received on loans, or from a buyer-seller relationship, example, service fees received for providing services, will remain subject to corporate tax. This distinction ensures that the exemption is reserved for income derived from genuine ownership and not from other commercial or financial transactions.